I want you to imagine a business that sells fewer items in an entire year than its mass market rivals sell in a few weeks.
Right, which is already a crazy premise.
Yeah, exactly. But despite that tiny volume, this company historically pulls in like an 18% operating margin.
That is just, I mean, it's wild. That is a level of profitability that most traditional manufacturers would look at and assume is either a typo or entirely impossible.
Right, because it just doesn't make sense on paper. But before we get into how they actually do it, subscribe to the Unlayered Global now, because this channel does not just explain the headline, it reveals the hidden system underneath it.
Absolutely.
And that is our mission today. We are looking at how Porsche constructed one of the most profitable machines in automotive history.
It really is a masterclass, in turning pure human emotion into unmatched pricing power.
It is. But we are also analyzing why that very same, flawless machine certainly collided with industrial reality, seeing its profits completely collapse to just 1.1% in 2025.
Yeah, the contrast between those two realities, the 18% peak and that brutal 1.1% drop, it shows us how delicate pricing power really is.
Exactly.
It forces us to ask how a company actually balances scaling up without watering down the prestige of the brand.
So let's get right into it. Think about the last time you bought a car. For you, a normal vehicle purchase is, a highly rational, calculated decision.
Right, you're crunching the numbers.
Yeah. You compare cargo space, fuel economy, reliability ratings, the insurance premiums, the monthly payments, all of that.
It's basically a math equation for most people.
Exactly. But when a buyer walks in to purchase a luxury sports car, they are not really asking about the gas mileage, are they?
Definitely not.
Yeah.
No one cares about miles per gallon at that level.
Right. They are asking a completely different question. They're asking, is this the car I have wanted since I was a teenager?
And the moment that emotional question enters the buyer's mind, the entire negotiation changes completely.
It's a totally different game.
It really is. You are no longer selling a functional tool to get from point A to point B. You are selling identity. You are selling a childhood memory, status, personal ambition.
Yeah, the emotional hook.
Exactly. When a physical product carries that much emotional weight, the buyer suddenly becomes far less sensitive to, the last few $1,000s on the sticker price.
Okay, let's unpack this, because they spent decades building this immense pricing power. And they did it almost entirely around one central vehicle, which is the 911.
The absolute icon of the brand.
Right. And it is fascinating how this single car doesn't actually have to be their biggest seller to completely dictate the economics of the whole company.
Yeah, it's crazy.
It essentially serves as a credibility engine.
That is a highly accurate way to frame it. The 911 maintains the myth of the brand. Think about the physical design of that car for a second.
Right, barely changes.
Exactly. The exterior shape evolves very, very slowly. The engine sits in the rear, which is exactly where the purists expect it to sit. The driving position feels completely familiar across decades.
Which is wild, because most automakers are, desperate to convince you that their new model is radically different from the old one.
Right. They want you to think it's a spaceship. But this company does the exact reverse. They convince you the new model has modern capabilities, sure, but it still perfectly belongs to the bloodline of that poster you had on your bedroom wall.
And that continuity, it basically acts as a license to charge a premium without destroying demand.
Absolutely.
But here is the reality check for you as the listener. The 911 is the myth, right? But the myth alone cannot pay all the bills.
Oh, no, not even close.
Let's look at the actual scale. In 2025, total deliveries sat at 279,449 vehicles. Out of those, only about 51,600 were 911s.
Which is a tiny fraction.
Yeah, it's wild. Meanwhile, the Macan and the Cayenne accounted for nearly 165,000 deliveries. That means SUVs represent 3 out of every 5 vehicles sold.
What's fascinating here is the absolute symbiosis between those two sides of the business.
I mean,
Well, the sports car protects the exclusivity, right?
well,
Because of the 911, those larger SUVs become incredibly desirable.
right, the halo effect.
Exactly. A buyer looking at a Cayenne might never take it to a racetrack. They just need to do the school run or, have a comfortable commute. But that SUV carries the halo of the sports car parked in the showroom next to it.
And in return, the SUVs provide the heavy lifting scale. Because modern vehicles are staggeringly expensive to develop before a factory even builds the first production model.
Oh, the upfront costs are just astronomical.
Yeah, you have crash testing, global emissions compliance, cybersecurity architectures, complex infotainment software, and just billions in tooling.
Right. And if they only sold low-volume sports cars, every single 911 would have to carry an impossibly large share of those baseline burdens.
They'd cost $1 million each.
Pretty much. So the SUVs widen the revenue base. They pay for the robotic assembly lines. They fund the technology. They basically keep the sports car division financially durable so it can continue to operate.
Wow. Okay, but scale alone isn't enough to reach luxury margins.
No, it's not.
To get there, you need customers to willingly inflate your own invoices. And this brings us to their second profit engine, which is personalization.
This is where it gets really lucrative.
Oh, yeah. They offer around 1,000 exclusive manufacturer options. Over a 5-year period, the average revenue per vehicle fitted with these options literally doubled.
Yeah, because when you buy one of these vehicles, the base price is just the opening handshake.
It's just the start.
Exactly. Then you start choosing the exterior paint to sample, the specific wheel alloys, the seat material, the color of the interior stitching, the tuned exhaust.
It never ends.
Right. The suspension calibration, the exact finish of the dashboard badge. I mean, even the color of the physical key you put in your pocket.
It's basically a high-stakes Build-A-Bear for adults.
That is exactly what it is.
You can spend hours on the configurator, and they will gladly charge you $1,000 just to ensure your seatbelts perfectly match the color of your golden retriever.
And people pay it.
They do. But let me push back on this for a second. In manufacturing, doesn't introducing thousands of minute variations usually destroy factory efficiency? I mean, Henry Ford famously wanted everything painted black just to keep the assembly line moving.
Well, in a mass market company, variation is an absolute headache.
Right.
It means complex supply chains, scheduling bottlenecks, and serious quality control risks. But they completely flipped that industrial logic.
Okay, how so?
They view variation as the actual product. The customer isn't really paying for the leather itself, you know?
Right, they're paying for the experience.
They're paying for the guarantee that they will never pull up to a traffic light and see an identical vehicle sitting in the next lane.
Oh, wow. And if you are sitting at home playing on the configurator, there is a huge psychological trap waiting for you.
Oh, definitely.
You spend hours comparing shades of gray, adding and removing carbon fiber trims. By the time you finish, you feel a genuine sense of ownership over a vehicle that hasn't even been built yet.
Exactly. Walking away from the deal at that point no longer feels like rejecting a corporate product.
It feels personal.
Right. It feels like abandoning your own personal creation. And that emotional gap between a standard off-the-lot vehicle and a highly personalized creation that represents pure margin, the customer is actively volunteering to raise the final price.
It's genius. So the front end is this bespoke emotional boutique. But let's look at the industrial back end, because there is a crucial strategic weapon here, which is the Volkswagen Group.
A massive advantage.
Right, and I want to challenge this setup. If the Cayenne is assembled at Volkswagen's multi-brand plant in Bratislava, isn't a Porsche just a mass-market car wearing a very expensive tailored suit?
That is a very common skeptical argument, but it actually misses how automotive value is engineered today.
Okay, correct me.
So yes, they share underlying chassis architectures, which dramatically lowers the baseline cost. But the engineering magic happens in the tuning.
The tuning, okay.
Yeah, they calibrate the steering response, they engineer the braking feel, they refine the exterior proportions, and they select the interior materials. They have to continually justify the badge through the actual driving dynamics.
Wait, so you are telling they get to utilize the buying power of one of the world's largest automakers, but they still get to charge boutique luxury prices?
Precisely. Think about an independent luxury manufacturer. They have immense authenticity, but they lack global scale, so their procurement costs are just astronomical.
Right, they can't buy parts cheaply.
Exactly. On the other hand, a mass market conglomerate has the scale, but they lack the scarcity and the pricing power.
Ah, I see.
So combining a boutique, highly tuned front end with a global industrial back end gives them a level of supplier leverage that an independent specialist couldn't even dream of achieving.
So what does this all mean? It means having scale and having high margins is impressive, but you have to actively protect it.
You really do.
You have to prevent the brand from becoming too common on the street. And that brings us to their philosophy of scarcity. This strategy is officially called value over volume. They actively restrict supply so it never runs ahead of demand.
And it creates a brilliant, disciplined financial chain reaction.
Let's trace the mechanics of it.
Sure, so if an automaker produces too many vehicles, availability becomes ordinary. When availability is ordinary, Dealers are forced to start discounting just to clear their inventory lots.
Right. You see those massive clearance sales.
Exactly. And discounting a brand new car immediately weakens the prices of the used versions of that same car.
Let me jump in there with an analogy for the listener. It is essentially like a company printing more shares of stock. The equity you already hold instantly becomes diluted.
And that's a perfect way to look at it.
And when those used car prices drop, you completely destroy the math for lease calculations and trade-in confidence.
Precisely. We call that residual value, which is the exact amount a bank expects the car to be worth when a 3-year lease expires. If a vehicle holds its value better, the bank knows they can sell it for a premium later, which makes the monthly lease payment significantly cheaper up front.
Because even incredibly wealthy buyers care about the monthly cash flow.
Oh, absolutely they do.
So by aggressively protecting those residual values, the company creates a highly effective commercial ladder for you as a buyer.
Right, they keep you in the ecosystem.
Yeah. Maybe you start by purchasing a pre-owned Macan. A few years later, because that Macan held its value so well, you have a strong trade-in to buy a brand new Cayenne.
Yep.
Later, you step up to a 911 and eventually maybe a GT model, which is their pinnacle track-focused tier.
And the manufacturer wins at every single step of that journey.
It's a money machine.
It really is. The exact same physical vehicle creates multiple revenue events over its lifespan.
Wait, really? Like what?
Well, there is the original sale, obviously, but then there's the initial financing, the dealer servicing, the trade-in acquisition, and then the certified pre-owned resale.
Wow, so they make money on the same car over and over.
Exactly. This disciplined scarcity is how they achieved their staggering 2023 performance. We are looking at $40.5 billion in revenue and an 18% operating return, which translates to $7.3 billion in pure profit.
Here's where it gets really interesting.
Yeah.
Because what happens when this meticulously engineered machine collides head-on with harsh geopolitical and market realities?
Yeah, the music stops.
Right. We have to examine the 2025 shock. In 2025, they generated $36.27 billion in revenue. That is still an enormous top-line number. But the operating profit completely collapsed to just $413 million.
It's just brutal.
It is. That mighty 18% margin fell to 1.1%.
It's a stunning reversal. And, it proves that pricing power is not a permanent, bulletproof possession.
Right, you can't just take it for granted.
No, it must be constantly defended against rising costs, shifting competition, and changing consumer preferences.
So what actually happened in 2025?
In 2025, they absorbed roughly $3.9 billion in extraordinary expenses. This was a combination of factory strategy realignment, spiking battery material costs, and new international tariffs.
Help me understand the unit economics here. If revenue drops by roughly 10%, how does the profit fall by 94%? That math feels incredibly punishing.
It is punishing, but this comes down to a fundamental business concept called operating leverage.
Right.
When you run an automotive company, your fixed costs are immense. You have to pay for the factories, the software engineering teams, the pension obligations, and the battery research, regardless of whether you sell one car or 1 million.
Right. Those bills are due no matter what.
Exactly. So the first several 100,000 vehicles you sell essentially just pay the utility bills and the salaries.
So all the actual profit is concentrated in those final marginal units they sell at the very end of the year.
Correct. When you lose volume, you aren't just trimming the fat. You are chopping off the specific units that generate the actual net profit. Yeah. Add to that the $3.9 billion in extraordinary expenses, money spent retooling facilities for batteries and absorbing import taxes, and that high fixed cost base suddenly becomes a heavy anchor dragging down the entire balance sheet.
Let's break down where that vital volume disappeared, starting with China. Because Chinese deliveries plummeted 26% in 2025, dropping to just 41,938 vehicles.
Which is a huge hit.
Yeah, it's massive. And for decades, European mechanical engineering was like the ultimate status symbol for wealthy Chinese buyers. How did that change so fast?
The very definition of premium shifted right beneath their feet.
Really, how?
Well, Chinese domestic brands evolved at a blistering pace. They started redefining luxury away from heritage and toward cutting-edge software, massive digital dashboard interfaces, superior battery range, and lightning-fast product updates.
So the whole paradigm shifted.
Yes. The traditional European definition of luxury, which is rooted in mechanical heritage and engine tuning, was suddenly challenged by a consumer base that views the car as a highly advanced digital living room.
So they were faced with a lethal choice. If you cut prices to compete with the domestic Chinese brands, you teach your wealthy customers to simply wait for discounts, completely eroding your premium prestige.
Exactly.
But if you hold your prices firm to protect the badge, you continue to lose massive amounts of volume.
And chasing volume through aggressive incentives is incredibly dangerous for a luxury brand. It unwinds that entire chain of residual value and lease calculations we discussed earlier.
Right, it ruins the math.
Yep. They have to find a way to rebuild relevance in the Chinese market without making the brand easier to buy than it should be.
And China is only half the geopolitical puzzle. Let's look at the United States, which is their largest overall sales region. But here is the fascinating detail. They manufacture 0 vehicles in the U.S.
Which leaves their most lucrative market completely exposed to global import tariffs.
Ah, I see.
Yeah, geopolitics is now baked directly into the sticker price on the dealership lot.
Wait, so you're telling me a buyer in California is essentially paying a geopolitical tax just for the privilege of the car being assembled in Stuttgart?
That's pretty much what's happening.
And the automakers' options are all terrible here. If they absorb the tariff costs themselves, their profit margins get crushed. If they raise the sticker prices, they risk scaring off even their wealthiest buyers.
Right.
And if they say, let's just build a factory in America, they risk ruining the entire origin story and European mystique that allows them to charge these prices in the first place.
It's a lose-lose-lose scenario. It demonstrates how an organization can be totally correct about its brand identity, but completely vulnerable to macroeconomic conditions.
Yeah, they can't control the world stage.
No, they can't. The finance department isn't just analyzing sports car demographics anymore. They are analyzing global shipping lanes, currency fluctuations, and international trade policy.
Which brings us to the most complex challenge of all, the transition to electric vehicles. There's an enormous tension here for you to consider as an observer of the industry.
It's the biggest tightrope walk in the automotive world right now.
Definitely. Because if they move too slowly toward electrification, they risk falling behind aggressive competitors and strict government regulators.
Right.
But if they move too fast, they waste billions of dollars in capital if the customers simply aren't ready to plug in. And a huge portion of their buyer base still absolutely demands the mechanical roar of a combustion engine.
If we connect this to the bigger picture,
Yeah.
the only rational response to that level of market uncertainty is manufacturing flexibility.
Okay, flexibility.
Yeah, a luxury company earns its margin by deeply understanding its customers' willingness to pay. You cannot force a rigid top-down management timetable onto a consumer base that is fundamentally driven by emotion and heritage.
So how do you engineer that flexibility on a physical factory floor? I mean, cars are massive physical objects.
Right. Well, look closely at their Leipzig facility. Historically, an automotive factory is designed to build one specific architecture. But they engineered the Leipzig assembly line to handle combustion engines, plug-in hybrids, and fully electric vehicles sequentially.
Wait, on the exact same line.
Yes. The marriage station, which is the point in the factory where the powertrain is bolted into the chassis, has to be entirely flexible.
That's wild.
It is. Car number 1 on the conveyor belt might get a V8 engine, and car number 2 right behind it gets a heavy lithium-ion battery pack.
That requires a staggering amount of logistical choreography.
It is an absolute engineering marvel. Instead of making a dramatic, inflexible promise to go fully electric by a certain calendar date, they built a physical system that allows them to seamlessly follow regional demand.
Ah, hedging their bets.
Exactly. If one market heavily adopts electric and another demands gasoline, the factory can supply both without halting production.
And we are already seeing that flexibility pay off. Because if we look at the financial signs of life from the first quarter of 2026, the machine is starting to wake up again.
The numbers are definitely looking better.
Yeah, they posted $8.4 billion in revenue and $595 million in operating profit. That represents a 7.1% margin.
Which, it is not the historical 18%, but it is vastly healthier than that 1.1% crash.
Right, a huge improvement. They also generated $514 million in net cash flow. And interestingly, their actual physical deliveries dropped sharper than the revenue did.
Which is the ultimate proof that the value over volume strategy is actually functioning properly.
Meaning what exactly?
Meaning they sold fewer physical cars, but they protected the pricing power of the ones they did sell. The brand possessed enough residual strength to prevent a drop in unit volume from causing a catastrophic drop in cash flow.
That makes total sense.
Yeah, it proves the profit machine was damaged by a strategic shock, but it was not permanently erased.
As we look toward the future, we have two very different potential outcomes here. Let's do a rapid summary of the bull case versus the bear case.
Okay, let's do it.
The bull case is that the 911 successfully remains the emotional center of gravity. The Volkswagen Group continues to provide essential industrial leverage. The extraordinary factory retooling costs fade away, and the Chinese market stabilizes at a lower but highly profitable volume level.
Right, that's the optimistic view. But the bear case assumes a much harsher reality.
Yeah, what does that look like?
It assumes that global tariffs remain a permanent structural cost on the business. It assumes that ongoing battery and software development will simply consume far more capital than personalized options can ever recover.
Which would just eat away at the margins forever.
Exactly. And worst of all, it assumes that Chinese competitors have permanently redefined what luxury means, leaving traditional mechanical heritage behind as an outdated concept.
So for you listening, how do you know which way this business is going to trend? Here are the key indicators you should watch.
This is what really matters.
First, watch their pricing relative to their volume. If they attempt to recover by offering widespread dealer discounts, they are in serious trouble.
Big red flag.
Yeah. Next, watch the sales strength of the 911 because it remains the credibility anchor for the entire brand identity.
Always.
Watch if customers keep voluntarily adding all those expensive custom options on the configurator. And crucially, watch the boundary line between their independent engineering and their integration with Volkswagen.
Yeah, that boundary is so important.
Right, because if the vehicles feel too heavily integrated, wealthy buyers will question if the premium price tag is actually justified.
This raises an important question. Because the deepest risk facing them moving forward isn't that they suddenly forget how to manufacture excellent automobiles.
No, they know how to build cars.
Exactly. The true risk is that automotive excellence simply becomes far more expensive to produce than the global consumer market is actually willing to reward.
And that leaves us with one final lingering thought for you to chew on. We've established that this entire high-margin business model relies heavily on the emotional resonance of the physical driving experience.
Right, the feel of the road.
The weighted steering feel.
Yeah.
The mechanical heritage. The roar of the engine. So what happens to their unparalleled pricing power in a future where autonomous driving makes the actual act of driving completely irrelevant?
It's a scary thought.
It is. When the steering wheel eventually disappears from the cabin entirely, what exactly are you paying a premium for?